Lay it out, Kathleen. What's expected?
Well, we're going to get a number that is still far too strong, far too high for the Fed, with some signs that there are parts that are maybe starting to cool off, a step in the right direction, but a long way from the finish line for the Fed. So let's take a look. In terms of the monthly numbers, first I want to point out, monthly numbers before we got into this huge inflation spiral upward used to be about 0.1, 0.2. So when you see that the headline is expected to rise to 0.6% from 0.4, you can comfort yourself knowing, well, it's a lot due to gas prices. They go up, or they may go down again, but that's the trend there. And then you look at the core CPI, which is actually supposed to go down 1/10, and that's partly because some things like used car prices are getting more into balance, supply and demand imbalance. That's the theme here. But when you look at those headline numbers, you can see 8.2% year over year down to 7.9 isn't much, and the core CPI is actually not making much progress either. So let's go inside. What's happening there? It's interesting that mentioning, again, goods and services, you can see from this Bloomberg chart that core goods prices are fairly well behaved, even food and energy prices on what they're doing sort of on a year-over-year monthly basis. It's still core services. When you go to a movie, when you pay a lawyer, when you ride on an airplane, all those prices are still much loftier than the Fed needs them to be. So what they're going to say probably, October numbers still too high. They're going to be a bit worried about inflation getting entrenched. You just mentioned Neil Kashkari. Well, Tom Barkin, who's president of the Richmond Fed, spoke earlier today at an event, and he made it pretty clear the Fed is very serious about doing as much as they have to do. They're not just going to start backing off unless they see something substantial. Here's what he said.
This slow return to normal levels of inflation could threaten the stability of inflation expectations. And if there's one thing we learned in the 70s is that the Fed cannot let inflation fester and expectations rise. If we back off for fear of a downturn, inflation comes back even stronger and requires even more restraint.
Charlie Evans, who's retiring as president of the Chicago Fed after 15 years, Chicago Fed, or all Fed presidents, when they hit 65, have to step down. He had a wonderful interview today with Matt Boesler from Bloomberg News. You can find it on the terminal. You can find it on the Bloomberg.com. And he talked about the benefits of getting to the point where inflation starts coming down enough that you can start slowing the pace of hikes. He's concerned that the Fed keeps doing a 75 basis point hike every time the inflation forecast misses to the upside, they could get the federal funds rate to a rate that is a level, I should say, that is maybe just a bit too high. So bottom line, you guys, I think we're seeing the debate for the December meeting stay at a 75 basis point hike or move down to 50 already beginning. This number will make a difference potentially, but ultimately I think they're going to look at the broader picture with the jobs numbers, financial stability, and all those things to make up their mind.